Welcome back everyone, and in this video, we're going to go over 5 of the top stocks to keep your eye on this week. We have a lot of variety in this week's episode with a combination of some high growth companies as well as a few dividend payers included in the list. And this is a recurring series on the channel where every Sunday we discuss the major events for the upcoming week and the companies that may be impacted. And these events include earnings reports, investor presentations, or product launches, and for each stock, we take a look at the company's current fundamentals and their future growth potential. And before we jump into stock number 1, I'm going to ask you, as always, to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and we're going to jump straight in to stock number 1, which is Adobe, ticker ADBE, and they currently trade for $441 per share. This is one of the largest software companies on the market, and from their lows back in March 2020, the share price has climbed up over 43%, and they now have a current market cap at $210 billion. But we can see from their high back in September of 2020, the company is now trading down over 17% at this current point in time. And the recent volatility of the tech sector has brought Adobe share price to a much more reasonable level at the $440 mark. And this is a company with top of the line products, and that's why they have some extremely strong brand loyalty. And year over year, they continue to expand their product mix, introducing new services to their ever-growing network of market-leading software products. And in 2020, the company performed extremely well. Their total revenue grew over 15% year over year to $12.87 billion. And their GAAP earnings per share was up 81%, and the company generated $5.73 billion of cash flow from operations, which was a record high for the company. And they're included in this week's episode because they report earnings on March 23rd, and we have a revenue estimate for the quarter of $3.76 billion and earnings per share of $2.79. And over the previous 4 quarters, the company has done an amazing job of beating analyst expectations each and every time. And for this next quarter, we're projecting over 22% year over year growth in the company's earnings per share. And if we take a look at their income statement, over the past 5 years, they've been growing at an astounding rate, going from $5.8 billion of total revenue back in 2016 to over $12.8 billion in the trailing 12 months. And if we take a look at their bottom line, they are extremely profitable as well, with over $5.2 billion of net income over the past year, which is another metric that continues to grow each and every year as well, with a mass acceleration over 2020. And for the next 5 years in the future, analysts are projecting over 16% per year growth from Adobe, and at this current point in time, the company is rated as a strong buy with a 1.8, and the current share price of $441 sits well below the 12-month expectation of $566 per share. And I think Adobe is definitely one of the top growth companies to keep on your watch list this week. They've declined over 17% from their 52-week high, and they're sharing their latest earnings on March 23rd. And now we're going to move on to stock number 2, which is PayPal, ticker PYPL, currently trading for $241 per share. And from their lows back in March 2020, the company has absolutely exploded, growing 157%, and they now have a market cap at $280 billion. But as of late, PayPal has seen a massive decline in share price, and from a high of over $300 per share, the company has now dropped over 20% back down to the $240 level. And PayPal is included in this week's episode because now may be one of the best opportunities to buy the dip on a leader in the fintech space, but also because the company's presenting at Bank of America's Electric Payment Solution Symposium that takes place on March 23rd. And I'm really looking forward to PayPal's presentation to get a greater understanding on their future outlook of the industry. And for the next 5 years in the future, PayPal has laid out some massive growth expectations for their business. They expect to double their active accounts to 750 million and triple their payment volume at a 25% CAGR all the way up to 2025. And with regard to total revenue, they believe they can grow it at over 20% per year and achieve 50 billion of annual revenue by 2025 as well. And as this revenue continues to grow at an exponential rate, they're projecting their annual earnings to grow at 22% as well, which is absolutely incredible. And if they can achieve these targets, we're going to see PayPal stock continuously climb to record highs each and every year. And going forward, analysts are projecting 20% revenue growth in this current fiscal year, followed by another 20% in 2022. And after that year end, we're expecting PayPal's revenue to cross $30 billion, which is absolutely insane. And we can see that for the next 5 years in the future, we have analyst projections of over 22% per year growth. And at this current level, they are also considered a strong buy at a 1.8, and the current share price of $241 is once again well below the 12-month expectation of $306 per share. So another big tech company that is on a massive decline of over 20% as of late, and maybe a nice addition to your portfolio over this upcoming week. And next, we're going to move out of the tech sector and into stock number 3, which is ticker NEE, Next Era Energy, who currently trades for $70 per share, and on the 12-month chart, they have grown by over 36%. They are a leader in the utility sector with a market cap right around $140 billion and a current yield of 2.17%. And as of late, they have been on a massive decline as well. From a high of over $86, the share price has fallen over 18%, back down to this $70 price point. And Next Era was the most recent purchase I made in my personal dividend growth portfolio, and I purchased 10 more shares of this company because I believe they're going to be a leader in the space going forward, and they have strong operations in both the traditional and the renewable space, which is expected to grow at 15% per year over the next decade. And Next Era has a very long history of delivering incredible financial results. And we can see that since 2005, their average earnings CAGR is at 8.7% per year, which is absolutely insane for the utility sector. And their annual dividend is growing at an average 9.6% over the past 15 years as well, which is another very impressive mark. And we can see that over the past decade, their total shareholder return is at 700%, grossly outperforming the S&P 500, which is at 267% over this past decade. So Next Era has more than doubled the performance of the overall market. And going forward, the company's projecting EPS growth between 6 and 8% over the next 2 years, and the annual dividend will grow at around 10% per year going forward as well, which is absolutely insane for a big utility company. And we can see that that current dividend has a yield of 2.17%. It only makes up 61% of their net income, which is very low and very sustainable. And their 5-year dividend CAGR is at 12.5%. And this is a dividend aristocrat with a 26-year streak of consecutive dividend growth. So I believe they are one of the top utility names, and you can pick them up right now on an 18% dip. And going forward, analysts are projecting around 8 to 9% per year share price growth, and they are currently ranked as a buy, coming in with a 2, and the current share price of $70 is once again well below the 12-month expectation of $87 per share, and I believe this is going to be one of the leaders in the utility sector for decades in the future. I just bought more shares of this company for my personal portfolio, and that's why I had to include them in this week's episode. And now on to stock number 4, we have ticker DRI, Darden Restaurants. They currently trade for $140 per share, and from the March lows, this company has absolutely exploded up 230%, and investors are piling into this restaurant company because of the reopening of the economy and the future benefit that they're expected to see. They have a current market cap at $18.24 billion with a current yield of 0.48%. And this is the company that owns numerous different restaurant chains, including Olive Garden, Longhorn, Cheddar's, and many more. And in total, they currently operate over 1,800 restaurants across the country. And as the vaccines continue to get distributed and more states are easing up on the pandemic restrictions, analysts are projecting that by late 2021, a majority of Darden restaurants will be once again operational with customers sitting at the tables. And that's a great sign for their investors. And this week, they report earnings on March 25th before the market opens. We have a revenue estimate of $1.6 billion and earnings per share of 68 cents. But over the past 90 days, we have 3 upward revisions, but also 16 downward revisions from analysts. So they're actually getting more bearish on this report coming in later this week. So if we see a bad report and Darden Restaurant sees a nice decline in share price, it might be a great opportunity to buy the dip in this leader in the restaurant space if you believe a reopening is going to send the shares much higher than where they are right now. And if we take a look at their income statement, year over year before the pandemic, the company was growing revenue at a very fast rate, and at year end 2019, they generated over $8.5 billion of total revenue. And then of course the pandemic happened, which sadly destroyed the restaurant industry, and we saw a decline in Darden's revenue back down to $6.8 billion in the trailing 12 months. But the fact that this company was still able to generate over $6.8 billion of total revenue during a year where most restaurants were forced to shut their doors forever is still very impressive. And I don't think the company was hit as hard as people were expecting. And if we take a look at their net income, pre-pandemic, this was a very profitable business with net income growing each and every year. But of course, they have been posting a slight decline of $115 million over the trailing 12 months. But going forward, analysts are projecting a very fast rebound in Darden's operations. And we can see in the 2022 fiscal year, they are projecting total sales growth of 31%, and the average estimate for total revenue is at $8.83 billion, which is absolutely incredible because that would mean by year end 2022, the company will have total revenue that surpasses their pre-pandemic high set back in 2019. So analysts are forecasting a very quick recovery in Darden's total operations. And we can see over the next 5 years in the future, we have very high expectations, and the company's projected to grow at 34+% each and every year, which would be absolutely incredible. And they are currently ranked as a buy, coming in at a 2.1. And at this current level, they're trading right around their 12-month expectation of $139 per share. So definitely another company in a fast-growing industry right now because investors are piling in to the potential recovery plays. But if we see any dip in share price over the next week related to the company's earnings report, it may be a great opportunity to buy a potential dip in a company that's projected to completely rebound by year-end 2022. And now we're going to finally transition into the 5th and final stock in this episode, which is ticker GIS or General Mills. They currently trade for $60 per share, and from the March lows, they have grown just under 12%. They have a current market cap at $36 billion, and they're trading with a current yield of 3.4%. And this is one of the larger consumer staple companies on the market right now with very strong operations, and many consumers eat their products every single day. And we can see in the first half of the 2021 fiscal year, they have been performing extremely well. Organic net sales are up 8%, operating profit is up 13%, and adjusted earnings per share has grown by 17%. And General Mills is included in this week's episode because they report earnings on March 24th, and we have a revenue estimate of $4.45 billion and earnings per share of 84 cents. And over the past 90 days, we have 4 upward revisions and only 1 single downgrade coming from the analysts. And we can see, jumping into their income statement, year over year, the company's operations are very consistent, and over the past 4 years, total revenue continues to grow, and in the trailing 12 months, usually when most companies saw a big decline in revenue due to the pandemic, General Mills was the complete opposite and have actually seen a nice acceleration, reaching a record high of $18.2 billion in total top line. And at this current level, with a share price of $60, the company's current dividend yield comes in at 3.4%, and it only makes up around 54% of their total net income, which is extremely sustainable. And going forward, analysts are projecting around 5% annual share price growth coming from General Mills. This is more of a slow growth and consistent company, but a 5% share price appreciation plus an over 3% dividend yield can provide investors with a total return of 8 to 9% each and every year from a consistent consumer brand that's always going to be needed on the shelves of grocery stores all across the country. So they were the fifth and final company to take a look at this week. They report earnings as well, and in this video, we went over 5 of the top stocks to keep on your watch list this week. We discussed the major companies who are reporting their latest quarterly results. We talked about an investor presentation and also a nice renewable company that's on a big dip as of late. And for a couple of the names we discussed today, they have seen a 15+ decline in share price over the past few weeks, meaning that now would be a great opportunity to buy the dip. And I want to thank you for watching to the end. I am the Gen Z Investor, and every single day we talk about the stock market. So please hit that like button, subscribe to the channel, join the community, and I will see you in tomorrow's video.